Hello traders, welcome back. In today's lesson, we are zeroing in on candlestick patterns. By the end of this lesson, you'll have a clear understanding of what these patterns represent, how to interpret them, and how to apply that insight to make informed trading decisions. Let's get started. What are candlestick patterns? Candlestick patterns are simply specific shapes or combination of candles on your chart that reveals what buyers and sellers are doing at a particular period, whether price is fighting, ranging, trending, rejecting a level, or building momentum. By reading these candlestick patterns, you get clues about what might happen next. This pattern helps us identify 4 key things: reversals, that's when price may be preparing to change direction; continuation, when price is trending in a certain direction and gives us a signal that price will continue in that direction; indecision, neither the buyers nor sellers are in control; momentum shift, when one side starts overpowering the other sides. There are well over 100 candlestick patterns out there, but today we are focusing on just 12. 6 bullish and 6 bearish. These patterns typically have success rate between 70 and 80% when used correctly and at the right zone. So let's get started. We are starting with the Doji candlestick. The Doji forms when the open and close price are almost equal or the same. This candle shows indecision. Neither buyers nor sellers are in control. A Doji doesn't just generate reversal signals. It gives you an understanding. It makes you understand that at the particular point where you are seeing it appear, it is telling you that neither the bulls nor the bears are in charge, and it's an indecision candle. A Doji is a plus sign. When you see a plus sign, you see the market going up with some candlesticks, and it gets to a certain point, you see a plus sign where the open and close are almost at the same point level. We have the high here and the low. So at this point, a Doji is both a bullish and bearish candlestick pattern. It's a bearish candlestick pattern when you see it at a buying market. When the market is trending upward, buying, and you see a Doji, it gives you a signal that you might see price change direction to the downside. And you don't just trade it when you see it, you wait for confirmation. To confirm this as a selling candlestick pattern, we need to see a candlestick with a body close below the low of the pattern. So once we get the Doji candlestick forms as we have it here, we mark out the low of the pattern, which is the lowest point the price went at that candlestick. Then we'll wait for the next candlestick to close. If the next candlestick closes with a body below the low of the pattern, that shows us momentum. Remember when we talked about a big range, big bodied candle, it tells us that sellers or buyers are in charge. For this, it will be a red candle with a big body, with a body closing below the low of the pattern, giving us confirmation that we can use this Doji candlestick pattern as a sell candle. In the reverse, if we have a candlestick with a body closed in the opposite direction above the high of the pattern, that invalidates this Doji. We will not use this candlestick as a pattern at this point again, because we've gotten a close with the candlestick body above the high of the pattern. Anyone that comes first, if we get a close with a body below, it gives us confirmation to sell. If we get a close above the high, it tells us that we might continue going to the upside. So if we have a close below the low, that's a confirmation for a sell. Because the market was on an uptrend, you can use it as a sell signal. If we get a close above the high of the Doji, it invalidates the Doji. It goes for continuation. The first candle might not give us the confirmation. We might have several candlestick bodies inside the range of the Doji between the high and the low. As long as we've not gotten a close below or above the high, that is not a confirmation until we get a candlestick with the body closing below the low of the doji. That gives us a confirmation. So that's the doji used as a bearish candlestick pattern. But if the market is coming downward and we get an indecision candle, which is a doji to the downside, what we'll need to confirm this doji, since it's a bullish pattern, we're going to be using it as a bullish pattern here. We need a candlestick with the body to close above the high of the pattern, which is going to be a green candlestick, telling us that buyers have stepped into the market, confirming that we can start looking for opportunity to buy to the upside. On the reverse, if we get a candlestick with the body close below the low of the doji, it's a sign telling us that we might have continuation of more candles dropping and continuation to the downside. So that's confirmation for doji and invalidation. The next candlestick we're going to be talking about is the Dragonfly Doji. The Dragonfly Doji is a bullish signal when it forms at the bottom of a downtrend. This tells us that sellers push the price downward strongly, but buyers stepped in and forced the closing price back up. If you remember when we talked about the wicks of the candlestick, it tells us about rejection. So the Dragonfly Doji is a cross sign. It's a bullish candlestick pattern. This is how it prints on the chart. We have a longer wick to the downside and a smaller wick up here. Then the close and the open are almost all at the same point. At this point, price was on a downward movement, and we see the Dragonfly appear. This is telling us rejection. If we want to use the sentiment, bias, and formation of the candlestick, if you look at this close above the upper half of the range, which is telling us that it's a bullish bias candle already, and we have a longer wick to the downside, telling us that it's rejecting lower prices. So for us to get a confirmation, the same thing, we'll mark the high of the pattern, and the next candle or any candle that comes and closes above the high of the pattern gives us confirmation to look for opportunity to buy to the upside. If we get a close below the low of the pattern, it invalidates it. If we get a close of a candlestick with a body below the pattern, it invalidates the Dragonfly Doji. So the first candle might not give us a confirmation. The second candle, if the third candle gives us confirmation closing above with a body, that's a good confirmation. Also, look for opportunity to buy to the upside. The next candle is the Gravestone Doji. It's the reverse of the Dragonfly. It's a bearish candlestick pattern. This is how it prints on the chart. We have a longer wick to the upside, smaller wick, and the open and the close almost at the same level. So this is a bearish pattern. We need price to be going up. Then we'll see it at a level where there's rejection. The longer wick is giving us rejection already, and we want confirmation. We want to see a candlestick with a body closing below the low of the candle, which is a pattern which is going to be a red candlestick, for confirmation to look for opportunity to continue selling to the downside. If we get a candlestick before confirmation, get a candlestick with the body close above the high of the pattern, that invalidates the pattern. We have to look for opportunity to get continuation of trade to the upside. The next pattern we'll be looking at is the hammer. The hammer is a bullish candlestick pattern that forms at a downtrend, has a smaller body at the top and a longer wick to the downside, a little or no wick to the upside. This shows sellers tries to push price lower, but were overwhelmed by buyers, giving us a hammer like the example we have here. A candle can either be green or red as long as we have a smaller body to the upside and a longer wick to the downside. Please don't get confused with the Dragonfly Doji or the Gravestone Doji with this. The Dragonfly Doji is a cross sign. We open and close almost at the same point, but for a hammer, we have a smaller body with a smaller wick to the upside. So this is what the hammer represents. smaller body up here, open and close gives us the body, then we have a longer wick to the downside. This is what the hammer looks like. The confirmation, the same thing. We mark out the high of the hammer because price was on the downtrend, met support somewhere around here. We wait for a candlestick body to close above the high to give us confirmation, to look for opportunity to buy to the upside. Then the invalidation of the pattern, where we will not use the pattern again, is when we have a close of a candle below the low of the pattern. That invalidates the hammer. So the reverse is shooting star. The reverse is shooting star. Shooting star is the bearish version of the hammer. A smaller body at the bottom, a longer wick to the upside. It forms at the top of an uptrend and signals buyers attempted to continue moving price upward, but sellers came in and took control over the market. So we'll have a candlestick that looks like this for shooting star. The same thing like the hammer, but it will be on the reverse facing downwards. So for us to confirm this pattern, we mark out the low. Since it's a bearish pattern, price has been on an up movement. We met support resistance somewhere. We'll need a candlestick with a body to close below the low of this candlestick pattern to give us confirmation to look for opportunity to sell to the downside. And this will be a red candlestick body. The reverse, if this candlestick, instead of getting a close to the downside, the low, we get a close above the high of the pattern with the candlestick body. That invalidates the candlestick pattern. We will not use the pattern again. If we get this first, we'll look for opportunity for continuation to the upside. So that's for shooting star. The next pattern on the list is bullish engulfing and bearish engulfing. Bullish engulfing pattern has two candlesticks forming the pattern. A smaller bearish candle, the first candle, followed by a large bodied green candle, a bullish candle, totally covering the body of the previous bearish candle. So these two candlesticks put together like we have in the example here, in the bearish engulfing, and the emphasis on this bearish engulfing is on the body size, not on the wicks. The body of the green candle should totally cover the body of the red candle. At this point, we have a bullish engulfing. What this means is that we had selling strength. When we talked about the smaller size candle, we talked about reduced strength and control. So if we have a smaller red candle, then we now have a bigger green candle. It tells us that buyers have totally overshadowed what sellers were doing. Like the example we have here, price was on a downward movement and we got to a certain point where we have the candlestick pattern. The green candle totally covering the body of the red candle. So in this instance where we have that play out with a bullish engulfing pattern like this. So what we'll need now to confirm this is for us to mark out the high of the pattern, combining the two candlesticks together. Which of the candlestick gave us the high of the pattern? For this is the green candle. We mark out the high. And for us to get confirmation, we need a candlestick with a body to close above the high of the pattern to give us confirmation that we can continue buying to the upside. For emphasis, we are only looking at the body of the candlesticks. So two candlesticks put together, the red candle and the green candle, the body of the green candle totally covering the body of the red candle. That gives us the bullish engulfing pattern. The reverse is the case for bearish engulfing pattern. For this bearish engulfing pattern, price has to be in an uptrend where we'll now have a green candle here. Then the next candle, which will be a red candle, body totally covering the body of the red candle, engulfing it. So for us to get a signal to sell on this, we mark out the low of the pattern. Then we'll now wait for confirmation for a candlestick with a body to close below the low of the pattern. We look for opportunity or maybe a pullback, and then we continue selling to the downside. That gives us confirmation for bearish engulfing. The next pattern we are looking at is the piercing pattern and dark cloud cover. The piercing pattern is a bullish reversal pattern. It's a combination of two candlesticks together forming the pattern. The second candle opens lower than the previous bearish candle, but buyers drive price above 50% of the bearish candle. For this, the example we have here, piercing pattern, combination of two candles, the red candle and the green candle. The green candle going above 50% of the body size of the red candle. If we have a movement like this to the downside, then we'll now have a red candlestick body closing at this point. Then the next candle, which will be a green candle, comes up and does more than 50% of what the red candle did, closing above 50% of what the red candle did. That gives us a confirmation. That gives us the pattern. Then we look for confirmation. We mark out the high of the pattern and we wait for a candlestick with a body to close above the high of the pattern to give us our confirmation to look for opportunity to buy to the upside. The reverse is the case for dark cloud cover. On the upper movement, we'll have a green candlestick form at this point, then a red candle forming next, doing more than 50% of the body of the green candle, closing in the second half of the green candle. This gives us the pattern, the dark cloud cover pattern, where we'll now mark out the low, look for the candlestick closing below the low of the pattern to give us confirmation, sell the downside. That's for piercing pattern and dark cloud cover. The next pattern we are talking about is the morning star and the evening star. The morning star and the evening star is a powerful 3-candlestick reversal pattern. It consists of a strong bearish candle, a small indecision candle, and a strong bullish candle. It tells you sellers are losing strength and buyers are stepping in with conviction. 3 candlesticks makes up the pattern. Like the example we have here, a red candle, a smaller body candle, then a green candle. Looking at the pattern, the morning star is a bullish pattern when price is trending downward and we get a red candlestick downward. This can either be green or red. We get an indecision candle, then we'll now get a bigger green candle to the upside. Combining these patterns together, we have the morning star, which is a bullish candlestick pattern. So for confirmation, we look for the candlestick that has the high of the pattern. That would be between the first and third candlestick. So if this gives us the high of the pattern, we mark the high. The confirmation is still the same for all bullish candle. We need a candlestick with a body to close above the high of the pattern, combining the 3 together to give us a continuation for us to buy to the upside. And for this pattern, I always love to see that this middle candle gives us the low of the pattern. When combining the 3, this middle candle should be the candle that is having the low, the ultimate low of the pattern. So if we get a candlestick with a body closing below it, that invalidates the pattern. We'll look for opportunity to look for more sales to the downside. So the reverse is the case for evening star. Evening star is a bullish candlestick pattern, 3 candlestick patterns. We'll want to see our bullish candlestick, then we get the next candlestick, then a bearish candlestick forming. 3 candlestick combines together gives us a pattern. At this point, we want to mark out the low since it's a bearish pattern and wait for confirmation. Confirmation will be a bearish candle closing below the low of the pattern to give us the opportunity to continue selling the downside. Like what we have in the example here on the screen, we had the green candle for evening star, the green candle, the smaller body candle, indecision candle, and the red candle. We mark out the low of the pattern, and the next candle closes with the body below the low, and we got an opportunity to sell to the downside. For morning star, same thing, the market was trending downward. We got the red candle, indecision candle. We had the green candle, we mark out the high, wait for a candlestick close above it, gives us opportunity to continue buying to the upside. Candlesticks, if you don't see them at a good location, they can be very deceptive. How to reduce noise. The clearer your chart, the clearer the stories the candles are telling you. So the first thing you need to do is you have to move to a higher time frame. The more you move to a higher time frame, you are zooming out, reducing the numbers of candles you are seeing, and the candlestick pattern works best on the higher time frame. So noise decreases as you zoom out. The 1 minute and the 5 minute charts are very noisy charts. It takes candlesticks to form on the 1 minute and 5 minutes time frame than on the 4 hours daily or weekly time frame. So once you go higher, you reduce the noise on those time frame. The next is you need to see those candlesticks at support and resistance zone. Support and resistance zone, these are levels that will cause rejection to happen in the market, and a candlestick you find at those levels will work best for you. So if you are looking for bullish candles, if you want your bullish candlesticks to be more profitable for you, look for them at support zones. For bearish candlesticks, look for them at resistance zone. Another way of reducing noise on the chart is for you to avoid trading during high impact news. High impact news. Wait, if a news is coming out, a red folder news, avoid entering the market 30 to 60 minutes before the news, or you wait 15 to 30 minutes after the news to take advantage of it. And again, always wait for confirmation. So instead of entering immediately after a pattern, wait for the next candle to break structure, to close below, for a bearish candle to close below the low with a body, and for bullish candles to close above the high of the candlestick. A bodied candle, the next candle should close above the high. If it doesn't, if it closes below, it invalidates the pattern. Final tips. Candlesticks are very powerful, but when used correctly. Here are key takeaways that can help you. Always combine your patterns with market structure. Look for them at key levels like support and resistance, supply and demand zone. Use multiple time frame analysis to analyze the pattern, and don't just trade the pattern at the middle of anywhere. Just look for it at a good spot that will be profitable for you. Always confirm that you are in a trend, and this candlestick is also helping you confirm your movement on the trend. When used in this context, your accuracy will skyrocket. So don't forget to like, share, and subscribe, and I'll see you in the next video.